Hello Wildcats, I am going to make this as simple and easy and quick as possible for you. We are looking to buy a call option in Etrade, so what we are going to do is open our Etrade accounts, scroll over to trading, scroll down to options, click that button, and what will pop up is the page that you are currently looking at that says options order. Now, obviously, you want to buy a call option on a certain stock or a certain ETF, so what you're going to do is put that stock or ETF into the symbol and hit enter. I'm using the QQQ as an example. The QQQ tracks the NASDAQ. Now you're going to get this bid and ask and the last price pop up. You can safely ignore that for the most part because that is for the stock or the ETF, and we are trading options, which is going to give us a different bid and ask for the particular option we're looking at. Now down here at select a strategy, we are buying a call option, so we are going to select call. Action is a buy open. We can leave that as is. Quantity is how many contracts you want to buy. In general, one contract is equivalent to having 100 shares in terms of power. So if a stock moves up $1 and you have a quantity of 1 in that call option, you're going to make about $100 for each $1 movement upward. Anyway, select your quantity. We'll just say 1 for now. And then select the expiration date. These expiration dates here where it says Q are weekly options, and everything else is not weekly. So for example, July 15, that's the monthly option. This kind of matters because the monthlies tend to be more popular. That's not actually true these days with the popular ETFs, but in general, if you're not trading something popular, let's say you're trading EPAC, which is something we recently traded, you're going to find that you don't have a lot of choices here, and you only have the monthlies. You have June, July, August, November. But if you're trading something highly liquid, you have a lot of expiration dates to choose from. Generally, the idea is the further out you go, the more value that option has, and the less time decay. So I like to go a little further out. If I'm not going to make a day trade or whatever, maybe I'll go to the first monthly one after June, after the current monthly one. So maybe I'd hop on over to the July call. Now the strike price is going to be at the money if it's close to this last price, the quote for the actual stock. It's going to be in the money if it's lower, and it's going to be out of the money if you go higher. Generally, if you're trading just a call option and you're doing it as a speculative trade, you think the QQQ is going to go up, you want to be around at the money in most cases, because at the money has the most gamma, which means that the improvement in value is faster than any other strike prices you can choose. So if you don't know what strike price you want, generally I recommend you stick with something at the money, which is basically going to be either the next dollar above the last price or the next dollar below it. So I would say both of these, 275 and the 276 strikes, both are considered at the money strike prices. Type call, and that's it. Now what we have are the bid and the asks, and this is where you need to make another decision. So the bid is what people are willing to buy that option for, and the ask is what people are willing to sell that option for. And you can see there is a discrepancy between these two prices. There's about a 14-cent discrepancy, which means that when you select your price, and I'm going to show you the best way to do it, you're going to want to choose limit. But before I get into that strategy, let's just say you choose market. When you choose market, what's going to happen is you're always going to get the worst possible price. You're going to get this ask price. You're going to pay $1,265 for this option. But you can see that bidders aren't paying that. Why? Because they know they can get a better price. And to get a better price, you need to choose limit. Once you choose limit, this box will pop up, limit price. And what you can do is you can put in the lowest possible price, which is at the moment $12.51. But that won't get filled. And the reason it won't get filled is because people are bidding at this price. The first possible price you can get filled at would be $12.52 because you're outbidding the highest bidder. This is essentially the highest bid, and you want to outbid them. Now, this is just a slightly above the highest bidder, so you're probably still not going to get your position filled. Generally, if you want to get your position filled very quickly and at a good price, you go halfway between the bid and the ask. A very safe one would be 12.6 because it's closer to the ask than the bid, but it's still in the midpoint. You're getting a better price than if you were to go with the market, which you'd be paying 12.65 for. But one strategy I like to do is just move it up in increments. I would put in maybe 55 because that's closer to the bid than the ask, and the stock's kind of moving up and down, so maybe you'll hit that price. But if you don't, what you can do is simply cancel that order, come back to this page, and move it up a bit. You can move it up to 57, you can move it up to 59, and you can keep doing that slowly by 1 penny increments for a popular stock like QQQ, and you can do it in 5 or 10 cent increments for a lesser popular stock. But in any case, by doing this, you're going to get the best possible price. You're not going to get ripped off. If you're trading a lot, this little strategy will add up for you. So let's say I want to just put in 255, 1255, see if that fills. If it doesn't, I'll come back and change it. And good for the day, I always just do good for the day because of this strategy. I'll come back and move the price up, and it'll eventually get filled. If you have some reason to know that the price, whatever your demanded price, will be hit in some time, you could do longer, good until 60 days or whatever. But this is my general strategy. How are we doing here on time? Okay, so that's a 5-minute video at this point. So let me use the remaining 4 minutes to explain how to close the trade. Now, once you're done making this trade and you've made your profit or you've lost and you want to close it and retain some of that capital that you put into the call option, what you can do is you come back to this page, you enter all the same info, with the only difference being instead of buy open, you sell close. And one beginner mistake, because it's quite common, is people choose sell open, which is completely different from what you're intending to do. If you have already bought to open a call option and then you sell to open a call option, what you're going to see in your account is a short call option and a long call option next to each other. You don't want that. You want to close your trade, right? So you bought to open. What you want to do is the exact opposite. What's the opposite of buy? Sell. What's the opposite of open? Close. So just remember it that way. I want to do the opposite of what I did before. I'm going to not buy, I'm going to sell. I'm not going to open, instead I'm going to close, sell to close. Exactly the same thing. Put in your limit price. The only difference here is you're looking for the highest price when you sell, so you want to be closer to that ask price. So let's say I want to try to sell it for 12.6, and that'll be a safe way to squeeze a little bit of extra money out of every trade you make, both when you open and when you close. So that's pretty much it. Anything else I wanted to say? Oh yeah, so market, I was saying that you usually don't want to go with market, and that's generally the case when you're making a trade in something that has a pretty big bid to ask spread. But if you're like me and you do a lot of quick day trades and you're using close expirations, so here's a weekly, here's the closest weekly. So you'll see the market's not open right now, but when the market opens, you'll find that these close expiration dates, like the weekly options, with at the money strike prices, which are strike prices close to the actual price of the stock, you'll find that the bid to ask difference is almost zero. And in that kind of situation, trying to fudge the limit to get the best possible price doesn't really make sense, because you're just going to get slippage. You're going to put in your order and the stock's going to run away from you, and you're not really saving any money anyway. So if you see that the bid and the ask spread is very tight, there's only a difference of maybe 5 cents or even 10 cents, I would just go with market, because once you do that and you enter your order, it's filled pretty much right away. So if you're looking at, for example, candlesticks or you're looking at some sort of technical signal like stochastics, and you see like a crossover and you're like, I want to get in now. Well, it's better to get in now and not save that 5 pennies that you would have saved with the limit. Just go with the market. But in most cases, if you're trading something, you have this small tech stock that you're interested in and you want to buy call options because you want to protect against the downside, and you're not really urgent to get into the trade, always just go with the limit, especially after you look at the bid and ask spread. If the bid and ask spread are big, you always want to go with the limit. So I'll show you this EPAC trade we did recently. We were buying call options on EPAC, and we're going with the August 1775. You can see this bid and ask. Right now the market's closed. The bid and ask spread is always going to be bigger when the market's closed, but this is huge anyway. If you go with the market order, you're going to be paying $340, and based on my calculations, the true intrinsic value of this call option should be around $220. So you're paying about $120 extra for this option if you go with market. So instead, we're going with limit, and we're going to put in something close to the actual value, and we're going to move that up. So if 2.1 doesn't get filled, we'll go with 2.15. If that doesn't get filled, 2.2. If I really want the trade, I'll go over what I think the intrinsic value is just to get in on the trade. But this is the most important part of making a call option purchase in E-Trade, is getting the limit price right, and of course getting all this other info correct. You don't want to buy to close. It won't let you buy to close anyway, but always buy to open for the start. After all, this video is to teach you how to buy a call option, so you don't even need to worry about that other stuff now. If you don't want to, come back to this video when you need to make the sale and review how to make the sale. Right now, if you're in a hurry to buy a call option, just follow this layout. Buy to open, put in your quantity, put in your expiration date, put in your strike price, make sure it's a call option, not a put option, and then based on how liquid and how large the spread between the bid and the ask are, either select market or limit, and then just go through with your trade. And that's it. Thanks for watching. If this video helped you, please subscribe and give me a like. My channel right now is kind of balanced between this kind of stock stuff and true crime stuff. I want to keep the stock stuff on the channel, even though the true crime stuff is more popular. So I would really appreciate some sort of feedback that lets me know that this is actually helping people. Thank you.